Namaskar and welcome to Sansad Television. I am Vishal Dahiya and you're watching our show Perspective, where we bring you detailed analysis of key national and international issues as well. Now, today we're going to talk about the new SEBI rules for IPOs. Stock markets across the world have witnessed a boom in IPO offerings, with a record amount of capital being raised by companies in 2021. The Indian securities market also witnessed robust growth during this period, both in terms of number of issues and the amount raised from equity market. Investment by retail individual investors in IPO has also grown from about 5,000 crore rupees during 2019-20 to 8,300 crore rupees during 2020 and 21, and almost 15,100 crore rupees till November 2021. Now, there are multiple IPOs lined up for 2022 as well, with a strong pipeline of companies, including both new age technology companies as well as some big names. Now, the Securities and Exchange Board of India, that is SEBI, has recently announced the rules for the initial public offerings or IPOs, both for investors as well as the issuing companies. These new rules deal with various aspects such as funds raised through IPOs and their utilization, preferential allotment pricing formula, offer for sale by existing shareholders, lock-in period for anchor investors, creation of subcategory for individual investors, and price band for book-built IPOs as well. In today's episode, we will discuss and analyze these changes in the rules and their impact as well. And for more on this, we're joined by a very distinguished panel of experts. Let me first introduce them to you. Beginning with, we have with us Mr. Madhu Devra, President and CFO, Group CFO of Paytm, who is joining us. Mr. Jitendranath Gupta is also with us, former Executive Director with SEBI. And we also have with us Mr. Yatish Rajawat. He is CEO of Center for Innovation in Public Policy, that is CIPP. Welcome, all of you gentlemen, to Sansad Television. Let me begin with you, Yatish, first, because I distinctly remember having a conversation with you on this show itself almost 2 months ago on this same issue. Now, the question is, if you look at these changes which have been made by SEBI, one, how would these changes impact? Of course, that is something really important we have to look at. But what are these changes, and specifically, how significant are them?
So, Vishal, going back to our older discussion, we basically discussed 3 issues. And we discussed, first was, of course, the valuation aspects of these IPOs. Second was what was happening to the proceeds of the IPO. That is, where were they being used, utilized? Were they being used to further the business, or were they being used for acquisition? And third was that what happens in case that the valuations are too high? And if you remember, one of the issues that we had discussed was to bring in, say, a third-party valuer or a credit rating agencies into the process, so that valuation for small investors could be more normal and could be more sensible at the same time. I mean, these are 2 loose definitions, but why I'm using these 2 loose words is because, I mean, as we saw in 2021, the valuation really went through the roof without any anchor of reality in it. So now, what SEBI has done, it has addressed some of these issues, but it has not addressed any of these issues fully. For instance, they have brought in the credit rating agencies, but they have only brought in the credit rating agencies to monitor the proceeds of the IPO, and they've extended the period of their monitoring. They have, of course, locked in anchor investors and how much can some investors dilute during the proceeds of the IPO. But the fundamental problem and fundamental challenge still remains that they have not touched the issue of valuation. And they have, while for preferential issues, they are saying that there will be an external valuer, but for IPOs, they have not laid out a process of how sensibility and normalization could happen in valuation, particularly for companies which are loss-making, because you cannot use the other methods of valuating there, whether it is earning or cash on the balance sheet or any other methodology. Vishal.
Okay. Fine. And if you look at those aspects, we'll bring in Mr. Jitendranath Gupta also. But we also have Mr. Vadut Devra. I'll first, go to him. Mr. Devra, your company has recently come out with an IPO, and when we are looking at these rule changes by SEBI, how has it changed the scenario, or how will it work for some other companies which are going to come up with IPOs in weeks or months to come?
Yeah, so thank you for having me on the show. So I think we obviously filed with SEBI in July, and we listed the company in November. So during that process, we got a little bit of an understanding, or much greater first-hand understanding of how SEBI is thinking about some of these issues. I think it is true that the types of companies, internet companies, new age companies, that are coming for listing right now are slightly different than the companies who have listed before. Most of the companies that have listed in India so far, they have raised money basically to do capital investment, right? So invest in investments that go on their balance sheet, right? They don't really go in their P&L right away.
Okay.
Whereas new age companies, for the most part, they are not very capital heavy. Their investments, whether they invest in employees, they invest in technology, all of them by accounting standards go onto their income statement. So there's been a little bit of a disconnect between the previous set of rules that existed versus what is applicable to new age companies. I think the second point that I would make is that there's some great companies that are getting built in India in the new age sector. I think many of us would be customers of these companies. And I think it is important that many of these companies get listed in India so that Indian investors are able to sort of participate in that growth story. I note with some concern that there are some companies who list in India, but there are also some companies that are listing overseas, right? And of course, it should be their choice, right? It should be their choice where they list. Especially if they're not incorporated in India, then they're actually by law free to list where they do. But it would be better if more and more companies list in India so that Indian mutual funds who represent basically Indian retail investors, but also Indian retail investors directly can participate in these companies. But I think in terms of these rules, I think that it was said, they're quite focused on what the money is being used for. And they're quite focused on ensuring that the process is followed properly.
Okay. So what you're saying, Mr. Devra, is that the new rules is basically an evolution mechanism to deal with, or rather to be in sync with the changing scenario of not only the companies, but also the business models out there as well. Mr. Jitendranath Gupta, I'd like to bring you in here now, and let's first understand from your perspective, since you've been there with SEBI, in terms of the changes which have been made, be it vis-a-vis anchor investors or the individual investors, or the utilization of the funds which will be raised by these companies via the IPOs. Some of them are said to be, quite significant in terms of the impact. The others, as Yatish was pointing out, might further need a tweak, perhaps a few months or few years down the line again.
First thing I want to make it clear that regulations will never be cast in stone. They will never become Qutub Minar or Taj Mahal to be static. They will keep on changing depending upon what is the need and what is the demand and what is right. That is the most important. SEBI as a regulator will take into account demand, need, everything, but they will only end up doing what they feel is the right. And how this right is decided. If you look at the SEBI mandate is three-pronged: develop, regulate, and protect. And SEBI has to balance this like a tripod very finely. If any of the leg or any activity, whether it is development or protection or regulation, becomes oversized compared to other two, the whole thing will collapse. So SEBI has to do a very fine balance. Now coming to all the changes, see what is happening. The first thing and foremost, which Mr. Rajawat was saying, the SEBI has still not touched the issue of valuation. No, I would say the SEBI should not and will never do that because SEBI is not in the business of valuation. SEBI principle is very clear, buyer beware. Now, how the buyer should be beware? They should be given all possible information that is required. If today SEBI find that there is additional information required, that they are adding. But then what is happening over a period of time? A prospectus which used to be 100 pages in 1992 has become 700, 800 pages, and it is so much overloaded with the information that it becomes almost useless for the investor. So SEBI has to do fine balancing. The second thing is this, that valuation is a very difficult business. Unlike a commodity, whether it is a tomato or a cement or a steel, there could be some valuation. But when you create new share, new company, which has no history, how do you value? You value it on the basis of what you expect the future. The entire stock market operates on the basis of what is the future expectation. Nobody looks at your past earning or today's earning. They see what you are going to earn in future. So future is a one thing which none of us can predict. So that is one weakness. The second thing is this, that everybody is critical of SEBI, that new age companies, loss-making companies. I will recall and go back that any company, whether it is Tata Steel or whether it is Birla Cement or whatever it may be, when they would have started on very first day, they would not have made profit. But yes, I agree, 60 years back or 70 years back, when you had set up a cement company, you knew that you will be producing cement, it will be sold, if not at 100 rupees, at 99 rupees, at 98 rupees. But in case of new age company, you do not know. I would say that even if TCS was to be born today, it would have drawn a valuation which is akin to what Paytm or others have drawn. But way back in 1969, nobody gave value to TCS. So things will change. I cannot be, if I was born in 50s, I cannot remain with that mindset of 50s. I got to become a mindset of 21 today and think ahead. The other problem that is there, that every time something goes wrong, SEBI is to be blamed. Till such time I was earning money in the IPO, no problem. But the moment I lose in one share, I start blaming SEBI. The other important thing that you spoke in the first sentence of your thing, that stock market has boomed. Now let us analyze why it has boomed. First and foremost, people say that the P ratio is high. Now understand that interest rate used to be 10% earlier, and now it has become 4.5%. Now P ratio has an inverse relationship with interest rate. If at 10% interest rate, P ratios are 15, the normal P ratio at 4.5% should be 25. That is what is my calculation. The second thing is this, avenues of investment have dried. Earlier, if you book a house at 3,000 rupees a square feet, 3 months down the line, you can sell it for 4,000 square feet without even paying anything. But that avenue is gone. Cash avenues have gone.
Indeed.
And lastly, just I will take 30 seconds more. Lastly, during the lockdown, if I was earning 1 lakh rupee a month, my expenditure became only 70,000. So most of the people who are salaried, earning 1 lakh rupees or around that, they had around 40 to 50% saving. And where that saving will go? Because people say that 4.5% in fixed deposit, it is better to risk 5% to dividend aa jata hai. So that thing has brought so much money to the market. So the statistics that you gave, if 5,000 crore has been put in by retail investor, it is not. They have put much more money through the secondary market, because when I applied for an IPO, I did not get. Immediately, I will try to buy it on the market. So it is a collective forces which is happening, not individual forces.
Indeed, those figures, Mr. Gupta, are just limited to the IPOs, and you're right there that there's a lot of money which has been invested by the retail investor in the stock market in the past year and a half or more than that period as well. Now, let me take those views which you expressed there to both Yatish and Mr. Devra as well. Yatish, I'll come to you first. Do you concur with Mr. Gupta's point? And in a sense, it's pretty valid there as well. SEBI's job is to regulate and make the buyer aware. Of course, SEBI will have to find that balance in terms of the overload of information and the important information.
Yes, so as Mr. Gupta rightly also pointed out, that there is just too much information. And when there is too much information, it comes with too much confusion. Hence, valuation for new age companies which do not have a predetermined or a pre-existing model in the market, it is left to the promoters and the merchant bankers.
Okay.
And the reason SEBI is blamed for not regulating it properly and also not protecting the investors in cases where the IPO valuation is much higher and now the share prices are either down by 30% or 40%, which is a loss to the investors. Now, let's look at the structure a little bit more closely here. When there is no, like for instance, in the cement plant, as Mr. Gupta said, there are other cement plants. So any new company which come out with an IPO, any new cement company which comes out with an IPO is pegged in value to an existing cement company.
Okay.
But if a delivery company or an internet-based delivery company comes out with an IPO, there is no previously existing listed model, or there is maybe one or two other companies also in private markets which are being the basis.
Mm-hmm.
Now, the challenge is that private market valuations are being transferred to public markets with as it is. Okay, and this generally does not happen, and this generally should not happen.
Okay.
Because private market valuations are between a very small set of investors, a few private equity investors or a few VCs who have the resources.
Okay.
And what does happen in those markets is that what is called as flipping. Valuations are raised upwards because it benefits the cohort downwards.
Okay. Okay. So, let me, Yatish, hold your thoughts there. Let me take this point right here to Mr. Devra as well. Mr. Devra, the evaluation part there, and we're looking at it from the prism of retail investors. Retail investors, of course, are a very significant part or significant component of the market there. Your companies come out with IPO. You would be pretty much aware of the importance of all section of investors out there. But the evaluation part, as both Mr. Gupta and Yatish are pointing out, how do you see things moving forward? Because for new age companies, there doesn't seem to be a set template which can be followed.
So I'll just make a couple of points here. So one is, yes, it is the case that in every generation or every few years, there will be new types of companies that would attempt to get listed. And it will be true that there might not be comparables, right, for those companies. There will always be the first power company to get listed, the first renewable power company to get listed, the first port to get listed, the first IT services company to get listed, the first software company, the first internet company. So it will be the case. I think there's a little bit of misunderstanding, and I think Gupta sir will agree with me that that promoters or companies and merchant bankers can decide the price of an IPO. In the stock exchange, they're buyers and sellers. Same way in the IPOs, they're buyers and sellers. So somebody could sit around and say, I want this much valuation. That is completely irrelevant unless there are enough and more investors who are willing to invest at that valuation.
Mm-hmm.
So I think there tends to be this tendency to say, okay, only one side decided the valuation. That's just not how it works, right? If investors are not willing to invest at that valuation, then it doesn't matter what the promoters think. It doesn't matter what the merchant bankers think. End of the day, it only matters what investors think.
Okay.
Actually, it is much more skewed in investors' favor. I will say that as a final point on this topic is, I think we're all very well served if investors are encouraged to invest only in companies that they understand.
Mm-hmm.
I think that is the fundamental point that we should have.
Okay.
And if one does not invest a certain sector, understand a certain sector, maybe they're better off putting money in a mutual fund, right? And if they understand a certain sector, or if they have high level of confidence in a company, then by all means, they should invest directly. Warren Buffett is considered the greatest investor of all times. He is very open about the fact that I don't understand many companies, but I only understand a few companies and I stick with them. And he's never come out and said, why did Google get listed? Just because he never invested in Google, because he said, I don't understand Google, right? I don't understand, for the longest time, he didn't invest in Apple or Amazon. He said, I didn't understand Amazon. I did not invest in it. He's not saying that Amazon should not get listed. He's not saying that Amazon, he has a right to understand Amazon. He said, there are plenty of things that I understand and there are plenty of things that I don't understand. And if I just focus on the types of things that I understand, then investing in the stock market can be quite beneficial for me. And he also says that retail investors should probably only invest in things that they understand, and for things that they don't understand, maybe they're better off going to mutual funds or ETFs and so on. But there tends to be this misunderstanding that somebody is forcing an investor to buy a certain share and so on. Of course, everyone feels bad when a company's share price goes down. If they're investors and they invested at a certain price and today they're sitting at today the share price is lower. Of course, you feel bad about that. But just to be clear, in the Indian IPO context, and company does not have control over that, right? So I cannot choose to say that I should take these investors and not those investors because those investors may not understand my share price or my company. So you follow the process to the T. And you have a book building process. So you say, I think maybe this sort of range is okay. What do investors think? And if the investors agree that that price sort of makes sense, if enough investors agree, then you have an IPO. And if investors don't agree, then you have a failed IPO. Then you got to go back and try again if you want to.
Indeed.
So those are my limited points.
Indeed, and that brings in focus again the aspect of investor awareness and investor education as well. Mr. Gupta, you wanted to say something on that aspect, and of course I would like you to throw some more light on this aspect in terms of awareness and education of the investors, retail investors specifically, as Mr. Devra was referring to.
Okay, I would say that I would certainly want evaluation to be done. But let us understand the process. If a company is absolutely new age, what a third party valuer know better than what I know myself. If somebody is to talk about Paytm, Madhur knows much better about Paytm than any EY, Deloitte or any company. That is first aspect. The second thing is this, yes, there is a problem because there are interested party involved in the valuation, that is the issuer themselves and the merchant banker. But then you are going to public, which is going to decide whether you are worthy or not. That is one part. But even if SEBI were to mandate that let it be valued by XYZ independent person. But I will give you two examples and you will understand. Satyam, when they wanted to merge their real estate arm with the Satyam, had gone and got the valuation done by EY. Satyam's auditor was PwC. And the result is for all of us to see. The second thing is that the valuer will be paid by the company itself, and then valuer will take all the data from the company itself because there is nothing in the public domain. And they will give a report. So let us go back to 2008 crisis, which was perpetuated by all the credit rating agency because there was a conflict issue. And then going to what Madhur said, do only what you understand. I am an electronics engineer from 77 vintage, but I don't understand today's electronics. So I will only invest what I know. So generally I invest in brick and mortar company because there is some physical asset to be seen. I have no idea how to value a software company or how to value a new tech company. That is, but most important point is this. What if I stop and the flight of capital takes to US or UK listing? Then then the problem comes, and there
Indeed.
is where the SEBI role is very critical. SEBI got to make sure that it is not going to have a race to the bottom and make it free for all,
Indeed.
but yet facilitate so much so that all the good and genuine players want to stick to India.
Indeed.
You got to take into account Indian interest also in mind.
Definitely.
The other thing is this, as we always say, that do your own homework. Don't rely on J.N. Gupta, Murli or Mr. Rajawat or anybody else. Do your homework, decide if it is worthy or not.
Indeed, indeed, Mr. Gupta, that's the perfect point which you made there. We're running short of time, but you summed it up very correctly that one should not rely on A, B, or C in terms of investors when we're talking about, and these new rules which have been brought in by SEBI in terms of changes vis-a-vis the IPOs. Of course, they will have a lot of impact and they've been made to stay in tune with the changing market scenario, changing business models as well. And the regulatory mechanism and the regulations are not cast in stone. Of course, we might see another review coming ahead as well. We'll keep you abreast of all that information and we'll bring you more detailed analysis as well. Till then, keep watching Sansad Television. Thank you.